Okay. Sid Miramontes here with Miramontes Capital's weekly market update. In the news coming up, folks, over the next 2 weeks, our corporate earnings are coming out. And your last quarter's performance from your major corporations that you may be invested in or may be considering investing in are coming out here. So should be a very, very good gauge of what to look forward to over the next 2 and 3/4 period of time. So we'll be looking out for that, and you should as well. A question that was asked of me recently was from Gail from Edison International. She asked the question, what happens in the 4th year of a presidential cycle or an election year? And what type of returns can I expect? Well, we went ahead and did some research and found that the 4th year of a presidential cycle or an election year is the second best year to invest in the past history of the 4 years that a president is in office. So the best year is the 3rd year, and of course 4th year would be the second best year to invest in after we did our research. Granted, those aren't guarantees of any future returns. That is just what has happened over the past history. As I always say, make sure that your portfolio matches your risk category and risk style, and make sure your bond and stock allocation is something that you're comfortable with. As always, we look forward to hearing from you and answer any questions or concerns you have. Look forward to your emails and calls. With China continuing to slow down, probably more than what was expected, and Europe being their largest trading partner, so they will be affected as well. Oil prices fluctuating here currently, interest rates possibly coming up here in the next week or two. All of this weighs into the markets, along with other news like unemployment numbers that recently came out, which were a little bit less than what was expected. So all of it together, of course, is creating volatility in our markets. And so with all the volatility, folks, sometimes what's forgotten is how dividends can play an important part in your portfolio. Whether you be a pre-retiree or a retiree, it affects and can benefit both portfolios. One way that that dividends affect positively are in a volatile market and in a downward market, the dividends that those portfolios pay or investments pay end up benefiting our portfolio in that they give us downside protection, they give us income, they give us returns when the markets are dropping. And also, you don't have to sell shares. So your shares in a volatile market or a downward market, trending market, you're not selling shares, so your shares aren't shrinking up as well. So with all of that combined, folks, those things can definitely benefit portfolios, and there are several areas in the markets right now that dividends are looking very, very attractive. So we look forward to hearing from you. Give me a call, email me, or visit us on Skype or FaceTime. We'd love to get a hold of you in any way we can. Look forward to hearing from you soon. Bonds. Bonds right now, with the markets being the way they are and the Fed looking at raising interest rates, or at least most of the experts expecting the Fed's going to raise interest rates, I want to discuss with you what types are the best bonds to buy depending on what's happening with interest rates. So typically when rates are starting to go up, if you want to protect your account and want to move into more conservative bonds, typically bonds on the lower end of the yield curve are the best bonds to buy. That just means that bonds that are the shorter term bonds are considered the lower end of the yield curve because they're lower as far as interest rates are concerned. So as you go up, typically the yield curve, or as you go longer, so short-term bonds are 0 to 2 years, excuse me. Intermediate bonds are normally 3 years to as long as 15 years. So that's higher on the yield curve. And long-term bonds are 15 to 30 years, which are yet higher in the yield curve. Normally, what ends up happening when interest rates are rising, the short-term bonds are going to be the best bonds to buy. And of course, if you're looking at moving your investments into more conservative investments and trying to protect your account a little more in these volatile times, well, shorter-term bonds are going to be probably going to be your best bet as far as in an interest rate rising environment. If, of course, interest rates are higher or super high, of course, that would be when you'd want to buy and lock into interest rates for long periods of time. So if rates are going higher and you want to buy the best bonds that would be suited to you, typically shortest term bonds would be the best in a rising interest rate environment. And when interest rates are going and are high already, well, you'd like to lock into for a long period of time. You'd want to buy those 15 to 30 year type of bonds. So hopefully, if you have any questions, we can hear from you. Send us an email or give us a call. Thanks so much. The market update. With the federal government not raising interest rates, it's created more volatility in the markets here recently. And with everyone not knowing if they're going to raise rates a quarter of a point or when they'll raise rates, that continues to give us some opportunities as far as buying. So today I want to talk to you real quickly about stocks and individual stocks. There is some opportunity out there as far as taking a look at increasing the dividends that you're receiving, because some very good paying companies that pay very good dividends have now, stock prices have dropped down. So now the percentage that they pay dividend wise is gone up significantly. So there's some opportunity there for you. And they may fit very, very nicely in your portfolio. Or there are some stocks out there where, hey, they're very, very well run and the stock prices have dropped down, where we might be able to get some pretty darn good growth for your portfolio. So both of these two may make sense for your portfolio depending on the type of risk you can take and that you understand in your portfolio and what makes sense for you. But depending on where you stand, you make your money, folks, when you buy. Meaning that when you buy in, whatever price that you bought that stock for will really determine how much the growth is. And so looking at things when the markets are down 2,000 points from their high now, this may be a very, very good opportunity for your portfolio to take advantage of increasing the yield or the dividends that you receive percentage-wise, or also give you a potential growth rate. So depending if the risk is appropriate, please contact my office. I look forward to hearing from you and talking to you soon. Update. The latest news is Volkswagen, for all the misappropriations that they've done on emissions of their vehicles, etc. That's thrown a little bit of flux into the market in the news. But also, too, there's also been some good news where, hey, you have Dell Computer in a $50 billion merger talks with EMC. So there's some bad news and some good news in the market. And in positions like this, it's like buying a piece of real estate, where if you're going to buy a home that you want to purchase and hold on to for a few years and then sell it down the road, what you're doing is you're positioning your investment for future growth. Well, that's what we're doing with your portfolios. The markets aren't as they were maybe in the past, where, hey, it's a buy and flip market. You're not buying a piece of property and turning around and selling it in 3 months period of time. We're buying this property to hold on to for 2, 3, 5 years into the future. And we can do that through a few different ways. We can do that through buying individual stocks, where I think the biggest discount is in individual stocks, if that fits your risk profile. Or we can look at a basket of stocks, which is what's called an exchange traded fund, which is called an ETF, which is more specific to a certain area of stocks, like pharmaceuticals or financials, and it's somewhere between 10 to as many as 500 stocks. Or you can look at a mutual fund that has even a broader range of stocks. But look at the market right now as a place that you can position and park yourself in place in some good things that you can expect to see your growth for the future. So look at it as we're positioning, folks. Look forward to hearing from you via email or calls. Thanks so much. Thanks for watching our video. Make sure to subscribe to our YouTube channel. We're constantly putting out valuable information for you, and we look forward to catching up with you on the next one.